Welcome back to the channel. Today's topic is we're going to talk about how are different types of investment withdrawals taxed. If you're new to the channel, my name's Chris Hammond, financial advisor at Hammond Wealth Advisory, where we help people out that are getting close to retirement, maybe have already retired. They want to have a good financial plan in place to help make sure they're making the right decisions, investing their portfolio right, thinking about taxes. And speaking of that, that's what we're going to talk about today. Because on this channel, we like to, like what I like to say, take a 20,000 foot view and look at some big principles and guidelines and things you need to think about when it comes to planning for your retirement. Now, this topic of how are different types of investment withdrawals taxed, the first thing I want to start out with is, what does this even matter? Like, why is this important? Well, one of the reasons this is so important is because you may not be aware that there are different ways our income is taxed. So we don't just have, when you think of like, oh, we have marginal tax rates. Well, that's like an income tax. But we have other tax rates as well that may or may not apply to withdrawals that come from investments. And understanding what those different taxes are can help you to work within the rules that the IRS has set out to help it to where long term, if you do the planning right, the goal is to hopefully long term pay lower in taxes throughout your years, especially in retirement. So let's talk about the different types of taxes that we have on income. You have the FICA tax. I think we're all familiar with that one. If you're a W-2 employee, you see FICA come out of your paycheck. That applies to your wages. If you are self-employed, then you have a thing called self-employment tax. And so you're probably very aware of that because you pay like the double of what the FICA is. And that goes to fund things like Social Security and Medicare. That's one type of tax. And then we have federal income tax. That's the one where we think of these marginal tax brackets that we're all very familiar with thinking about. There's also capital gains. You have short-term capital gains and long-term capital gains that are taxed at their own tax rate as well. And then you have, some of you may live in states that have a state income tax, and even those may have different ways that they choose which income they're going to tax. Some of them may say we don't tax Social Security benefits, or some might say they do. Some may say we don't tax IRA withdrawals or retirement account withdrawals, and some might say we do. So it's dependent on the state that you're in. But we have these different types of income. So the question is, how are your investments taxed when you take withdrawals from them? Well, a good way to do this is, let's break this down into the three main ways an account is going to be classified. We have brokerage accounts. These are like non-qualified accounts. Then you have your typical IRA, 401k, whatever your employer-sponsored plan is. If you're a federal employee, it may be a TSP is what it's going to be. That's what that is. These are pre-tax. And then you have the other type of tax treatment is for a Roth IRA, or a Roth 401k, or a Roth TSP. You get the idea. So that's the three different types of accounts and that you would put investments in. So how are these taxed? Well, let's break this down a little bit. Let's start over with the brokerage account. So brokerage accounts, these are like, you'd call these taxable accounts. And what that means is that every year, you're going to get a 1099 on it. Even if it's a CD in the bank, if it's not inside an IRA and you just have a CD at the bank, or for instance, you're going to earn some interest on it. You're going to get a 1099 from it. If you have a brokerage account and you have some stocks in it, you're going to get dividends probably paid to you for that year. And you're going to have a 1099 that your custodian is going to give you at the end of the year that's going to say, this is the dividends that were received, and you have to claim it as income and pay tax on it. So you might have to pay tax on dividends each year. If you have some bonds and they pay interest, I have to pay that as well. Dividends, they can be taxed as ordinary income if they're just an ordinary dividend, or if it's a qualified dividend, it gets more preferential treatment at the capital gains tax rate, which is a lower, more preferable tax rate to pay for those as well. Interest is going to be taxed as regular income. You're going to pay on income tax for that as well, unless you're looking at some things that might have like municipal bonds or something like that that might be tax-free at the federal level, something like that. You might also, in your brokerage account, you might have sold some stocks, for instance, and had a gain on it. Say you bought a stock at 50, you sold it at 75, and you had a $25 gain on that. Or you bought it at 50, you sold it at 75, $25 capital gain. And so you would then get a 1099 that shows capital gain on that. And if that capital gain is a short-term capital gain, then it's going to count as just regular income to be taxed as income tax. And if it's a long-term one, it gets at the more preferential capital gains rate. That's a much better rate to be at that saves you money. So you can see already, depending on the types of income that come from these, there's different tax rates that apply to this. So it's very important to keep that in mind. Now, another thing to keep in mind is that you don't pay FICA tax on this. FICA and self-employment tax applies to your wages, is what it is. Wages is for FICA. Self-employment tax is the profitability of your business if you're self-employed. So that's something to keep in mind. Now, the other way, another type of classification would be these IRAs and these 401ks, which are pre-tax accounts. And in other words, when you put money into a 401k or an IRA, you get to take a deduction on your income taxes for that year. So it's going in pre-tax. So that means when you pull out money from your IRA or your 401k, you're going to pay the income tax rate that you're in for that. That's where you think about we're in a marginal tax brackets and all that kind of stuff, wherever you fall in that. If you pull them out from these without an exception, you pull them out before age 59 and a half, you may in addition pay a 10% penalty as well on that. But if you wait until after 59 and a half and you follow the rules on that, you shouldn't have to worry about that. So you can see that anything that comes out of the IRA 401k accounts is taxed at the regular income tax rate, which is whatever marginal tax bracket you're in or whatever it pushes you into. It may push you into a higher marginal tax bracket. That's how that's worked. Whereas with the brokerage accounts, you have some things that are taxed at the income tax rate that you're in, but you have some things that might be a long-term capital gain as well, like long-term capital gains or qualified dividends. Now, so there's some differences already that you're seeing. Now, the last one is the Roth, and since you have already paid tax on it, the money that has grown to all of it comes out tax-free at that point. So you pay 0% tax on those, as long as you followed the rules like the 5-year rule, things like that we're not going to go into right here. Now, why is this important to you when you're looking at your retirement plan? Well, taxes are going to be a huge expense for one of the biggest expenses that most anybody is going to pay during retirement. They're going to pay taxes on any withdrawals that they're going to take from IRAs, assuming they are, don't have it all written off with their standard deduction, and most people don't fall into that situation. So you're going to have to pay taxes on it. One thing that's important to keep in mind is that if you are in a situation, let's say you're pulling money from your IRA 401k and you have finally filled up, you're in the 12% marginal bracket and you have finally filled that up. If you claim an additional dollar, those additional dollars are going to be in the 12 to 22% bracket. Just an example, right? Then you may say, you know what, maybe now it's time that we took money over here from the Roth IRA because it'd be tax-free. If I pull any more from my IRA, I'm going to have to pay 22% tax on it. Maybe I don't want to do that. Maybe I need to start taking from my Roth. Or you might look over and say, I've got some stocks that had appreciated and I've got some gains in them. Maybe I could just sell some of those and I'll just pay the lower capital gains tax rate, which would be better than going into the 22% marginal tax rate for income taxes if you take more withdrawals, say right over here from your IRA. All right. This is really important because if you have this tax diversification with some money in this account, some money in this type of an account, some money in this type of account, you have flexibility to work within what the tax code allows you to do and potentially minimize your taxes. What does that mean for you? Well, the more you can minimize the taxes, the less you have to pull from your portfolio, the longer your portfolio can last to protect you, to take care of you in retirement, or if you're wanting to just pass it on to your kids and grandkids one day, it's more that's going to be available for them as well. All right. So super important stuff to keep in mind here. All right, that's all I got for today. If you want some more retirement resources, head on over to retirementplanningmadeeasy.com. You can download a free copy of the essential step-by-step retirement guide. It's going to walk you through a couple of things that are going to help you out, point you in the right direction for planning your retirement. So just head on over there and check that out. And that's all I got for today. I'll see you guys on the next video. And as always, thanks for watching.